Okay, welcome everybody for our briefing from LGNZ. So this is a presentation on the Ratepayer Assistance Scheme. We are lucky enough to have Scott, the CE of LGNZ, and Hugo, who is a partner of Cameron and Partners and the lead advisor who has been working with LGNZ on the Ratepayers Assistance Scheme. So we have 45 minutes this morning for this conversation, and happy to hand over to you guys whenever you're ready. If you push the right hand button, you'll go up red. That means everyone can hear you correctly, and happy to hand over.
Great, thank you very much. Thank you for the introduction and thanks for the invitation to present the Ratepayer Assistance Scheme. I'm Scott Nicklin, recently appointed Chief Executive at Local Government New Zealand, although I have been around LGNZ for about 14 years, so not new to LGNZ, but new to the role. And with me is Hugo Ellis, partner at Cameron and Partners, who are our lead advisor in the development of the Ratepayer Assistance Scheme. Cameron and Partners and Hugo were also the lead advisor for the establishment of the Local Government Funding Agency, so really good pedigree and understanding of the space, and obviously natural choice when we started to think about the Ratepayer Assistance Scheme. And in fact, it was initially their concept idea when they were engaging with Auckland Council in the development of the funding agency. I also just want to acknowledge Mark Butcher, who's the Chief Executive of the Local Government Funding Agency. Couldn't be here today, but he has been travelling the country with us when we've been doing these presentations. The funding agency are hugely supportive of the RAS. They've been with us on this journey as we've been developing it, and also are very keen as an agency to potentially take an equity share when we actually get to that point in standing this up. So I just wanted to recognise Mark Butcher and the funding agency. And we've also had some other partners along the way, which I'll talk about later, but people like ICA and Rewa Aotearoa, and also about 8 funding councils that have helped develop and pay for the development of the business case to date. We'll take about probably, we can talk, I'll just warn you, we can talk about the RAS for hours. We won't do that, I promise, but please jump in with questions at any time. I'll do some introductory comments and set up the conversation. I'll then pass to Hugo, who will take us through in a bit more detail how the RAS operates, and particularly the 3 products and the business case. But please jump in with any questions as you go away. The more interactive this is, the better it is, and I guess the more interesting it is as well for everybody. So if you have any questions, please ask at any time. Before we get into the development of the RAS, I just want to touch on the success of the Local Government Funding Agency, and it was established in 2011, and it saved ratepayers approximately or close to $1 billion in interest fees because of the way it leverages the security of rates, how it then finances councils, and obviously pass that saving on to council. So it saved close to $1 billion in interest rates since 2011. So when we were starting to think about the Ratepayer Assistance Scheme, we wanted to look at what was the secret sauce behind the success of the funding agency, so we could then understand what that was and then make sure that we built that into the development of the Ratepayer Assistance Scheme. And so I guess there's a couple of things that stood out. First of all, that I guess the security of rates and the value that has in terms of getting the best possible interest rate from the markets. And then looking at the fact that the funding agency effectively is a shared service for the sector, and it effectively then has the specialist competency and skill set that councils don't necessarily have the need to have, or potentially don't have the scale to have in-house. So it has that specialist competency, they're specialist in the area, and then effectively it leverages that shared service element. It was also designed and majority owned by local authorities, and so that also just meant that it really has a public benefit. And so that was really important, one of our important kind of philosophies as we were developing the Ratepayer Assistance Scheme. How do we make sure this is a shared service? It's got the specialist capability, and it's designed and operated, it's designed by local authorities, owned by local authorities in conjunction with central government. And so there have been some of the principles we've used as we've developed the RAS. So I guess the first thing is what is the RAS? So the RAS effectively is a financing vehicle for ratepayers. So it's different from funding agency. The funding agency obviously supports councils in terms of its financing. The Ratepayer Assistance Scheme actually lends money to ratepayers, but it keeps councils whole. And so we are leading into a cost of living issues. We're obviously seeing insurance go up. We've currently got a petrol crisis, so a lot of people are feeling pressure from those cost of living factors. And we've also got an ageing population. So we have an ageing population. They potentially have significant equity in their properties, but they're on fixed incomes, and they're actually struggling to potentially, afford interest payments, groceries, petrol, and obviously rates is one of those as well. So just kind of looking at that demographic, and I guess the begoning demographic of people that will be on fixed incomes in the coming years. And so the RAS addresses affordability. It potentially removes a barrier to housing development, and it also helps improve our housing stock. There are three applications, or three sort of product categories, and I'm going to hand to Hugo in a minute to talk us through in detail these particular categories. But the first is the development contribution / development levies. So the Ratepayer Assistance Scheme effectively would finance the development contributions. It would keep council whole, so get paid up front, and so therefore it removes one of those barriers to housing growth and development. And Hugo will go into a bit more detail in a moment. So we see that as a real benefit. It also provides a benefit to the homeowner, because effectively that development contribution will be financed at about 2% less than the standard mortgage rate. So there's a saving there to the homeowner. We've then got a category called impact loans, and the first category we're kind of looking at the moment is solar, so solar panels, batteries, and potentially EV charging, hot water, etc. And so the idea here is that it's to help home improvements, but home improvements that have a public benefit. So not to potentially remodel your kitchen or to buy a boat or buy a new car. It's actually something that has a public benefit. So obviously solar fits into that, and there are a number of other categories. And it's a way in which we can help ratepayers finance the installation, say, for example, of solar panels, and then get the benefits from that saving in terms of energy consumption. And then the third is the rates postponement. So as already mentioned, we've got an ageing population, they're on a fixed income, and potentially we've got a number of people that are in their property at the moment. They are facing increased costs, and they're wanting to stay in their own property and think about how they finance things maybe more effectively. And so the rates postponement will allow them to effectively finance their rates, again at about 2% cheaper than a standard mortgage rate. And obviously it gives them choice. So their choices are to either, potentially take a reverse mortgage, which would be 5 to 6% more than a standard mortgage rate. So the RAS would be significantly cheaper. Obviously they have the option of selling their property. However, there is increasing evidence to, the importance of connection to family and friends, and there's increasing evidence that highlights if you're socially isolated, that has some huge mental wellness issues. And so this just gives people choice when they're thinking about these things. So I'll hand to Hugo now, who can take us through each of the product lines. I'll just move through that. I've covered most of that. So the first one, development contributions. So please, if you have any questions as we go, please just shout out.
Thanks, Scott. Just sort of stepping back, as Scott said, we first got involved with the RAS when we were doing some work with Auckland Council, and at that stage Auckland Council had identified the demographic shift that was happening in New Zealand, and the fact that there'd be a growing cohort of ratepayers that would be on fixed incomes and would be struggling to pay rates as they continually increase and increase because they need to pay for infrastructure, etc., etc. And so we sort of sat down with Auckland Council and tried to work out what was it that was required from a new way of doing things. And the first one was it needed to be sort of low cost, it needed to be off balance sheet, and it needed to be low cost for the ratepayer, off balance sheet for the council, and super efficient. So the idea was that it would be a national shared service so that all local authorities could access it. And as we developed the model, which leant heavily on the learnings from the establishment of the LGFA, we realised that the RAS could be applied to more than just rates postponement. It could be applied to other products, and the products that we've been focusing on have been deferred DCs, impact loans, and rates postponement. And so just talking about deferred DCs, as you know, DCs are a really big source of revenue for councils. The analysis of the 2026 long-term plans indicates that councils are expecting to raise about 700 million nationally from DCs, but that excludes water care infrastructure growth charges, which is another 200 million. So it's 900 million, and given the sort of change or policy initiatives at central government, the expectation is it's growing. It's only going to get bigger. There's a requirement for councils to fund a growth infrastructure, and that's just going to lend itself to more and more higher DCs. The feedback we've had from the funding councils is that, ironically, DCs tend to inhibit growth, which is exactly not what they're meant to do. And there's been a lot of inbound inquiry to councils about different ways of paying for DCs. And so some councils have actually ended up discounting DCs to encourage growth, and that's just simply a transfer from existing ratepayers to new ratepayers by doing that. And there's been talk about, could the timing be changed of DCs, and that's exactly what a deferred DC is intended to do. So rather than a developer being required to pay upfront for a DC, they can choose to convert that
Are you
into
still at home, my love?
John, you might want to turn your mic off, mate.
Sorry.
Sorry, I've lost my train of thought. And so it effectively enables developers to decide to convert that payment into a 30-year payment that would be applied to the owner of the property over the 30 years in the future. From the council's point of view, if the developer chooses to do that, the RAS makes payment of the DC up front, so the council's kept completely whole, and then the developer, while they own the property, will be required to pay effectively a 30th of whatever the total DC is plus interest, and then subsequent owners of the property would equally have to pay that levy as well. So from a council's point of view, the council gets its money. It's providing an option to the developer, and we've engaged with Newlands and the Property Council and various commercial developers and had a really positive response from them to this type of product. One of the issues that has been raised, though, is does this create an opportunity for developers to effectively get a windfall gain because they're not paying the DC up front? I guess there's the incentive. The developer always wants to make money. Do they just continue to charge the same price for the property and therefore, get the value of the DC themselves, which they capture, but then the owner of the property still has to pay the DC over time? And the way it's intended that would be addressed is that it would be very transparent what the development levy is that sits against the property. So as part of the legislation that we're seeking government to support is that there will be a requirement on real estate agents and conveyancing lawyers to highlight to buyers of properties whether there's a levy that sits against the property. And the RAS will be able to calculate on a daily basis how much that levy is, so that that would be part of the information that would be provided to sellers and buyers of the property when the transaction's happening. And the owner of the property has the ability to repay the deferred DC at any point in time as well. So it could be that a property owner decides they want to buy the property, they just don't want to have the levy in place, in which case they would require either the owner of the property to repay it, or that they decide they'll repay it, but they'll have to hold back a certain amount of cash to repay that levy at the time. So I might just pause there and see if there's any questions about deferred DCs.
I have one quick one. How do the property owners know that development levy is against their property? Is that on a LIM report or? Yeah,
good question. So there'll be a flag against the rating information database and on the LIM, correct?
Okay, cool. Tracy. That was my question.
And so it should be really transparent. As if the conveyancing lawyer should be doing this in any event, but there are various charges that sit against properties, and they should be making the buyers of those properties aware.
Yeah, that's what I was thinking about. For someone, you don't want them to get a surprise that is sitting against that property. Sarah.
So would this be a separate charge, or would that be contained within a rates bill for that owner?
Another very good question. So the process we've gone through is with the funding council. So there's 8 funding councils. They have been heavily involved in the the structuring of the RAS, and this is one of the key issues that was, was raised. Initially we had thought the simplest way would be for the councils to include the RAS levy against their rates invoice. The feedback from those councils was that there's multiple systems around the country and it would just create complications. And so what's proposed now is that the RAS will invoice ratepayers directly. But part of the arrangements with councils is that there'll need to be good sharing of information so that the RAS has all the details that they need to be able to do that.
Yeah. Which segues into second question. I guess as a council, we would need to have it made very clear that this was not a council charge, but is something that has been passed on by the developer originally or opted into by the developer. So clarity, I guess, is going to be key here.
Yeah, it's a difficult one because the RAS is effectively a shared service for councils.
Yes.
So it is actually.
Yes.
You're correct in the sense that it's a separate entity that will be doing the charge, but it's heavily related to the council itself, and the levy that the RAS will charge will rank pari passu with rates, and so there'll be almost a cross-default situation. So if the levy's not paid, then that's an issue for the council, and if the council's rates aren't paid, that's an issue for the RAS as well. So I think both council and RAS need to be aware.
Yes.
Of that interrelationship.
Yeah, and just ensuring that the customer at the end of the day is really clear on where that's coming from.
Yeah, so and particularly with the DCs, I think the key thing is that it's an opt-in arrangement for both the developer initially and also for the buyer of the property. They can repay that levy themselves, or they could require the previous owner to repay it before they acquire the property. As well.
So it could be a negotiation point when you've got a sale and purchase agreement for a property.
Correct. Yeah.
Okay, thank you.
Big Red.
Just with this, for development, wonderful, 33 section subdivision, 30k, 40k development fees due to be paid at 224 stage, $1.2 million bill, you've got a $1.2 million you've got to fund in order to get titles issued. Wonderful thing. To pass this on to the homeowner and pull it away from developers is just rubbish, and I think it's the biggest scam that we'll see if we're taking this off the responsibility of developers and passing it on to homeowners. And if it comes into this setup, I'd be very, very concerned. And when I refer to the setup as a Selwyn District Council, as I said, no problems with the developer lending the money to get 224 issued. I understand it's a big expense at the last minute of the subdivision, but for the developers to turn around and flick this onto the homeowners and go, oh, yeah, it's just a charge, it's something else we'll add on to your LIM report or rates, I think it's just morally wrong.
And I think this is the thing. We're here to get a briefing on the options that are available through the Ratepayer Assistance Scheme, and some of these might work for us and some of them might not in that space. And I think that is the concern, and you talked about, there being the windfall gain for the developer and making sure that isn't actually the case.
So just first of all, just to step back. So obviously there are three product lines, so deferred development contributions, rates postponement, and obviously the impact loans. You as a council have a choice as to whether or not you want to enable all three for your ratepayers. So you could still potentially port the Ratepayer Assistance Scheme but choose not to activate one of the product lines. So that is an option for you. In terms of just kind of, I guess, countering your thoughts there. So effectively after a property development and at the sale of that property, the purchaser is, let's say it's a $700,000 property. If it's got a development contribution through the RAS sitting to it, they could either pay the $700,000, have it all paid off, and it's kind of how it happens now, or they could pay, say, $650,000, and then they've got a $50,000 levy that they need to pay off. Now, if you step back and go, actually, they've got to finance that property. So let's say they're taking a mortgage of 500,000. They'd be better off having 50,000 through the RAS at 2% less than the mortgage rate, because that's extra cash in their pocket, and then financing the rest through obviously the bank. And then obviously they've got a little bit of extra cash in their pocket, or they could actually channel that to pay off the 450,000. So there is a benefit there, assuming, of course, that is passed on to the property owner. And that's where, there is work to be done with the conveyancing, and obviously we'd want it in the legislation that it's transparent, and they are giving that choice right up front at purchase. So I don't know whether that helps clarify, or whether you've still got concerns, but just thought I would outline that.
Also, another thing to note is there's obviously commercial developers, then there's mums and dads that subdivide their section and put a granny flat on the back, but they still have to pay DCs. In many cases, they aren't intending to sell the property immediately, but having to fork out an extra 50 grand up front can really skew the economics for them. So it just provides options to property owners, whether they be developers or mums and dads that own properties.
Thank you. Aaron.
Yeah, I share Red's concerns that this could unwittingly lumber residents with sort of costs they don't fully understand, especially as it's new and being introduced. But the question I had is that DCs, if we collect DCs, that's associated with a plan of work that we've got, and if we don't spend those DCs within 10 years, we're theoretically offering them back. With a developer, it doesn't always happen because I've moved on to the next thing and they don't sort of chase us up perhaps, but I could imagine that if I had a 30-year debt of 50k and I was told that this is associated with my community getting a new community centre, and that didn't eventuate within 10 years, that I'll be coming back to the council and asking for a refund. How do you see that happening or being managed?
I mean, it's a good question, and it's a sort of point of detail that has been identified. I mean, just being upfront, we've done a lot of work on the business case, but there's still detail that we need to work through, and that's one of the issues that we would have to work through. My understanding from councils is that it's been very rare, if at all, that developers have ever come back and sort of asked for compensation.
Yeah, because the developers moved on to the next big thing, and
Yeah.
what happened 10 years ago is immaterial. They might have gone out of business, but if I've got that personal debt and I'm only 10 years through paying it off, I'm much more incentivised to come and ask for a refund.
I suspect, and this will be a relationship between the RAS, and the council actually. So if there's a case, it'll need to be the RAS, or firstly the ratepayers that are paying the levy would come to the RAS, and then the RAS would probably need to look back to the council and to seek to be repaid.
It's one of those risks we need to look at managing.
Yep.
Race.
Thank you very much, Hugo. I think you've explained it pretty well. Red stole a little bit of the thunder, but I truly ask what problem you're solving here. You are increasing the speed of development by doing this. It's watering down the liabilities and length of time for funding. I take your point, Scott, on the spreading the loan, and I can see that would help for a mum and dad. But on a greater scale for a council, it actually seems like there's a lot of problems in administration that come through having to do this, and that is the detail that you're talking about, Hugo. I guess it will be, thank you for, it's a really good overview, but that detail would need to be understood about what those problems are and what are you actually solving here, bar funding and accelerating development versus all the administration and issues that it's creating.
Yeah, and you completely acknowledge there's still a lot of detail that would need to be worked through. But we spent 6 months with those 8 funding councils working through each of the products. And in many ways, the RAS is simply a financing tool or financing entity. We worked with PwC's IT team to scope the required IT system we'd need. And surprisingly, it's actually not that complex. The products themselves are relatively straightforward financing products. And so the system isn't particularly complicated. Where it does get complicated is the interrelationship with councils, and that's the sharing of information and things. But say for a DC, a developer would have the option of paying the DC up front or converting it into a levy. At that point, assuming it goes through the sort of application, or the developer goes through the application process and it's approved, if it's approved, the RAS just makes the payment to the council. The council's kept whole, and then it's up to the RAS to have an ongoing relationship with that property owner where it simply imposes a levy on that property owner going forward. So from a council's point of view, it's pretty simple, really. The council's kept whole. And then the RAS has the ongoing obligation to levy the ratepayer to get repaid. And that's by and large the arrangement with each of the products. So the intention is to remove the administration away from the council as much as possible and let that lie with the RAS.
Yeah, okay, so that does give them more of a definitive line. It was originally, councils and then the sharing of information and all the rest. But if it is a it's a financial sales package that we're hearing, I just with Councillor McGlinchey's point on DC's back and those one-offs, I see that it could be beneficial, but I just was concerned about the issues that it could bring to the council.
Yep.
If I can just touch on the problem that we're trying to solve, and so obviously the sector has limited funding and financing tools, and so when we were in conversation, particularly with the 8 funding councils, one of the issues that they raised was that they were either hitting their debt ceilings, and therefore development contributions or deferring those was an issue for them in terms of their debt ceiling. We've got a rates cap environment potentially coming, which is going to just make that even more problematic. But actually, they also wanted to encourage housing development and generally grow their district. And then we were talking to a couple of councils who actually were discounting DCs to be able to attract growth. And so to Hugo's point, it's basically a transfer from existing ratepayers to new ratepayers. And some of those councils were in high deprivation areas. So actually a lot of the ratepayers couldn't afford that. So there was just those, again, just gives you choices and options. Yeah.
Yeah. And I guess that's probably where this market might be a little bit different to some of
Yeah.
Absolutely. Yeah.
I was going to say, I think we sit in a slightly different space, but I wonder, just taking most of the comments on board around this, I'm really interested to hear about impact loans and the rates postponement piece, and noting that we are 10 past 12. So we've got...
Sorry, we'll try and...
Sure, we'll move on to the next one.
Is it,
Can
Tracy just really...
I'll try, I'll be really quick. Is it underwritten by the government?
No.
Who's funding it?
The shareholders would be central government, LGFA, and taking approximately 40% of the shares, and then the rest, the 60% remaining, would be spread across local authorities.
So when you talk about the 8 founding councils, what do you mean?
Oh, sorry, funding councils.
The 8 funding councils? So they are funding this?
So they've funded to date, we've had 8 councils fund the development business case. And so it'll be basically modelled off the local government funding agency, which effectively is jointly owned by central government and local government.
Got it.
And so when we get the green light and we get the legislation stood up, there will be an equity raise. Now, you don't have to be a shareholder to enable access. Just to say, you can use the funding agency without having to be a shareholder of the funding agency. Exactly the same model. At this point in time, we're just looking for in-principle support from council, so we can go back to the government. To date, I think we just sent a letter to key ministers. There were 21 mayors that have signed this. We've spoken to probably another half dozen councils who will be taking resolutions, and I think we'll be getting their support as well. So at the moment, we're just looking for in-principle support, so we can go to the government and go, actually, there is broad support for this across the sector. When we get the green light, then we will be going back out, obviously, to the 8 funding, the councils that have funded the development to date, as well as other councils who have expressed interest, and potentially there will be an opportunity then to take a shareholding. But you don't have to take a shareholding to allow access.
Quick question. Could councils who opt into this have a requirement on their adoption of it that the developers pay back the RAS on the sale of the property? Thereby it would give the developers the cash flow benefit, but it wouldn't lumber the complexity of the residents being involved.
At the moment, we're looking to make a homogenous product across all councils without having individual councils having certain conditions attached. So, I mean, in principle, yes, but we're trying to avoid complications at this stage.
Okay.
the plug I would make there is when we greenlight this and we're looking for equity, then I would suggest that taking some equity and then being a shareholder and having voting rights would potentially help then design that policy. Yep.
So, just moving on to impact loans,
Yes.
which impact stands for Investment for Modernising Properties and Community Transformation. So it's quite a mouthful. But the intention behind it is that they're loans that provide private benefit but public benefit. And at the moment, councils can provide these types of loans to ratepayers and get repaid through voluntary targeted rate. And essentially that's what an impact loan is, but rather than the council doing it, it's being done through the RAS. And there's examples around the country where councils have schemes in place to help ratepayers put in home heating, insulation, double glazing, etc. So there's a number of schemes around the country, and all that the impact loans are is effectively sort of stepping in and enabling councils to continue to do that, but doing it off balance sheet in a much more efficient and effective way, because there's been a number of examples where councils have done this and they haven't done a very good job of it because they're just not set up to run finance companies, and ultimately it does end up using up balance sheet capacity, which can be used for other purposes. And I mean, I think the best example is Auckland Council, which had a home insulation scheme that Auckland Council, the super city, inherited from Waitakere City Council. It had about 30 million. The intention was to roll it out across Auckland, but the forecast showed that it was going to grow to be well over 100 million, at which point the council went, it's 100 million, we can't spend on other things. And as it turned out, they had been calculating interest incorrectly. They had to fess up to the FMA, and it was a big mess essentially. And that's the the largest council in New Zealand, finding it difficult to actually administer these types of these loans. The focus that we've had for the business case has been on 4 types of products, and they are solar panels, home batteries, heat pumps and water heat pumps. And the reason we've done that is we've worked really closely with Ika and Rewiring Aotearoa, who've done a lot of work on these particular products, and their analysis shows that households would be able to use an impact loan through the reduction in their electricity bills. They would actually be better off by $1,000 each year in terms of cash. So there's actually an immediate cash flow benefit from potentially using these loans for ratepayers. On top of that, there's all the other spin-off benefits, energy resiliency, distributed generation across the country, etc. So there's a lot to sort of, get behind with the impact loans. Impact loans could also potentially over time be expanded to a much wider set of financing options. Things like flood protection, seawalls, stock exclusion fencing, for example, are just some of the examples of what it could be applied to.
And just to note that obviously the banks, the 4 leading banks provide green loans. The research that we've got is about 80% of the market is actually, they're not available to about 80% of the market. You have to have a mortgage with that particular bank. I think Westpac is the best one. You get 5 years, I think it's 0 interest, but at that point it then goes to the full interest. So a large part of the market is actually kept out of these options as well. So this would just open it up to a much broader market, and obviously it's not capped to a 2 or 3 year or 5 year, preferred interest rate as well.
And particularly retirees that really struggle to get bank financing, given that they've got limited income, which is one of the key tests for banks.
I think there's a few questions on this, so Sophie.
Yeah, kia ora guys. I really like this idea, thank you. Just touching on what you mentioned just before about green loans and how they've quite often got a time limited discount on the interest rate there. If you had somebody, for instance, who had purchased some solar panels using one of those loans, and now it's going on to that full rate, and potentially that full rate could be 5, 6, 7%. Is there an option within this to transfer that loan into the RAS? Because if for instance, they'd taken that original loan when this wasn't available, that sort of thing.
Not at this stage. And one of the reasons for that is one of the requirements would be that to be able to use an impact loan, the council would need to certify, or some party would need to certify who the installer was of that loan and the product itself. So I guess there'd be no visibility on who'd done the work and the nature of the product itself. So that could be a bit tricky to achieve.
Fair enough. Cool. Thank you very much.
Sarah.
Thank you. Again, I see this as, really important in the equity space for our communities. Would it be available to any rate-paying entity? I'm just thinking where there are trusts out there who own their own assets, who, could potentially benefit from putting solar on and reducing operational costs for them through that. Would that be an option as well?
Yep, in principle, yes.
Yeah. What about, thoughts of extending it to the likes of EVs with reverse battery functions so that can then work with their homes?
One of the sort of key principles of impact loans is that the investment must be in the property.
Right.
If someone can drive the EV away,
Not
then
so much.
no,
Yeah.
not so much. Yeah.
And the other thing would be, is there sort of, how tight will the criteria be around the benefits? In terms of ensuring the life of the product, the quality of the product, etc.
That's one of the reasons why these products have been chosen, because they are mature products and they're well understood. Ultimately, we'd expect additional products to be added, but it has to go through quite a robust process. So firstly, a council or a group of councils would need to get together to put a proposal to the RAS. The RAS is structured like the LGFA, where it has a shareholder council and an independent board. Both those governance bodies would need to approve the proposal. It would then need to go to government to be approved. So, that the products need to meet certain criteria, and that will be checked on the way through.
Yep. And final question is, where you have got ratepayers who don't live in that home, where it's an investment property for tenants, is there a way that we can potentially encourage that investment from homeowners so that their tenants potentially benefit from lower operating costs in that home?
I mean, ultimately, it's up to the ratepayer
Yep.
to decide. So, hopefully, the fact that they're potentially sort of cash flow positive, etc., is will the economics might sort of play out, because you'd expect that, a home with solar panels on it, with a home battery, for example, will be more attractive than one without, and it might be reflected in better rental rates that you can get. So we can't force ratepayers to do things, and the whole idea is that it's optional, but hopefully the economics play out.
Yeah.
And there is, not close to the detail, but there is actually some work going on in Queenstown, and Rewa Aotearoa are supporting that, and that's looking at options for rental properties,
Yep.
and I guess the benefits to the tenants, and obviously the benefits to the homeowner as well. So that is possible. So once we've gone through that process, and once we've got a bit of learning from there, then it could be potentially applied.
Great. Thank you.
Bruce.
And just very quickly getting into some detail, so you went through the solar and those sorts of things. So water, so water filtration for a home would fit the green criteria.
Yep.
And so if somebody came in and wanted a dechlorination scenario and they didn't want chlorine in their water, where would you be sitting on that?
It's up to the councils. If the councils believe there's a demand for it and it's appropriate, then the council put the proposal forward, and then that would go through the process. Once it's approved, then it can be rolled out across the country.
So the liability would sit with the council on the proposal.
Or it's,
If it was around dechlorination, chemical treating of water, etc., but that would be on property. So
one of the criteria would, that would need to, one of the boxes that needs to be checked on the way through is the technology mature and well understood? Will it last? How long will it last before it needs to be replaced? All those things need to be factored in. But it's up to councils to put forward proposals to get those products approved.
Okay, so I guess I go back to the amount of workload on councils for this product.
So I guess we've started with the kind of solar angle, because actually it's effectively that would be a national category. So I kind of see it more as categories as opposed to products. Solar makes sense because obviously there's ECA are really interested in this, Rio Aotearoa are supportive, so that would be effectively a national category. That would be then available through the RAS, so ratepayers could get that financing. ECA have done a lot of work in terms of just how they make sure that there's quality assurance around providers, products, etc. So they'll be able to bring that. So that's kind of a natural space in solar. There will be other, I guess, national categories that might, come out of this down the track, particularly once the RAS is up and running and kind of has a better understanding of how this works. And so there might be kind of ideas where there are other things, water capture, for example, might be one of those. And then there is the option for councils to go or regions to go, we've got a particular issue here. Obviously, there will be others, I would imagine, around the country that have a similar issue as well. So therefore, there is the ability to put up this issue here to go, actually, we've got some thoughts here, we'd like to see this, and then obviously that would have to go through to the RAS shareholding to get approval. And so obviously we want to make it as efficient as possible, but yes, there would obviously need to be some sort of back work. I guess where I see this working is where it's homogenous type products. So, I don't see it as council having to understand who the suppliers are. We'd be looking for, I guess, some national guidance around that. You could, but that would be up to councils to make those decisions.
And so that's whole of life, right? Because you talked about how long the product lasts versus the debt loan and payback, etc. So I appreciate that economic. So on the solar scenario, on the whole of life, has anybody come up with the disposal of the solar panels at the end of life?
The solar panels are effectively owned by the property owner. You're talking about what happens when they don't. Where do they go? Sorry.
No. Okay. Thought I'd just land.
Thanks, Sophie.
Yeah, sorry to come back with another one. I forgot my second question. So I was just wondering, when we say a ratepayer assistance scheme, can an organisation that happens to be a ratepayer go? So I'm thinking of, for instance, we have plenty of local organisations who, for instance, manage an AMP showground, and they might have a building there, and they would want to put solar panels on that, for instance. Is that something that would be available there, or is it usually tied to individuals?
No. So in terms of the products, the deferred DCs and impact loans can be companies, trusts, individuals. Rates postponement, though, needs to be an individual. Because obviously companies are perpetual and trusts are very long lived, and we need to have at least some event that will trigger repayment, which is under the rates postponement. That's what's required.
Cool. No, thank you. That explains that very clearly. Thank you.
Great, which leads us into rates postponement.
Okay, and this is where it all started with Auckland Council. Everyone's aware New Zealand's going through a massive demographic shift, and it's actually not just New Zealand. Actually, it's most of the developed world is experiencing the same demographic shift with an ageing population. And it's coming at a time in New Zealand when New Zealanders have deferred investment in infrastructure for decades and now needs to catch up. And unfortunately, there's different sources of funding for infrastructure. It could be taxpayers, ratepayers or users, and I think the government's saying it's unlikely to be taxpayers, and user pays has challenges. So the real impost is going to fall on property owners. And there's been a lot of talk about rates capping, but the charges will still come through, and whether they come through councils or whether they come through water entities or another source, the impost on on ratepayers is only going to increase. And unfortunately, a big chunk of those, or a big proportion of those ratepayers, will be retired on fixed incomes. So how does that get managed? And I guess one of the ways that can be dealt with is by now allowing those ratepayers to efficiently access equity in their properties. And what rates postponement is effectively a reverse mortgage. They're obviously offered by the likes of Heartland and SBS at the moment. The problem with reverse mortgages is that they're really expensive. And what the RAS can do is provide effectively a reverse mortgage, but at very low rates. So our analysis suggests that the RAS would be providing a reverse mortgage effectively at rates 4 to 5% below what reverse mortgage providers charge. It will also charge a one-off establishment fee of $100 flat upfront, and it won't be charged if the the ratepayer decides to postpone rates in subsequent years. So it's a much more efficient way for ratepayers to defer paying their rates, which they'll repay when they sell the property or ultimately pass away and the property's sold. When we looked around globally for precedents for the scheme, we came across a great scheme in British Columbia, which has been in place, I think it's since 1974. And that's, British Columbia's got a lot of similarities to New Zealand. It's got 5 million people. They've got a property tax system, which is very much like the rating system here in New Zealand. And there's a Kiwi that runs the scheme over there, and she's been really helpful. She's given a lot of her time to us to help us understand how their scheme works. When we looked at it in 2016, the British Columbia scheme had 670 million in loans. That's more than quadrupled since that time. So in 2024, it had 2.7 billion in loans. We think it's well over 3 billion now. That's about 83,000 users. And represents about 3.9% of British Columbia property owners. So you can see when a scheme's in place and people understand it, how much demand there is for the scheme. We actually asked her, what was it that's caused the growth, and she said it's just two things. It's just the demographic shift that everyone's experiencing, but also we went from being a legacy system where it was a paper-based application process where people had to come into the office, 2 forms of ID, etc., and sit down and work their way through the application, and they've moved to an online application process, which is much more efficient. It's 20 to 30 minutes required. It just meant that the friction that's involved with applying has been reduced considerably, and so people are using it much more than they did previously.
Cool. Questions on rates postponement? I've got Sarah.
Thank you. Again, another very exciting one, especially as the number of ratepayers on fixed incomes is ever increasing, and so are our rates. With the British Columbia model and potentially the way we model this, will that modelling of different scenarios be available to our ratepayers so they can really get a good understanding? Will it be like you can go into a bank and, there's a bank calculator for your mortgage, etc.?
Yep. I mean, that's what we envisaged. So to become a member of the RAS, councils need to do certain things, and one of them is assisting RAS to originate these loans effectively, and that'll be through having on their websites pages that are dedicated to the RAS products.
Yeah.
We'd envisage certainly with rates postponement, that there would need to be a calculator involved for, quite a simple calculator for ratepayers to be able to actually sort of plug in, some assumptions as to what that means for them over time in terms of what they might ultimately owe against that property.
Yeah, I could see us having to do quite a thorough engagement job with this, especially with some of our older ratepayers out there. In terms of the financing rates, about 2% below equivalent floating mortgage rates. Any risk to that you can foresee? Do you think that will be a fairly consistent one going forward?
It's always, we're also always driving while looking in the rear vision mirror. So that analysis is based on assumptions that we've made in the modelling and applying it to what's happened historically.
Yeah.
But the key assumption that we've made in the modelling is that the RAS will make a net interest margin of 1%. So for every 100 million in loans, it will make $1 million to cover its own costs.
Great.
And that's and then we've made an assumption actually where will we be able to raise our financing from, and the RAS will borrow from the LGFA at least initially, and so we're really confident around what that interest rate will be. Based on what's happened for the last 10 years, we're pretty confident about that number, and we don't foresee any reason why that won't hold going forward.
And I guess just to add to that, when the RAS breaks even and effectively is driving a surplus, at that point in time, it'll be actually up to the RAS shareholders to decide whether or not they want to give a return on investment to the shareholders. Obviously, pass on 2%, circa 2% less, so pass on that saving, potentially give a return to shareholders, or potentially pass on an increased saving. So that's an option at that point in time, which the shareholders, obviously, of the RAS would make decisions about.
Great, thank you.
Aaron.
Do you see the model being, is it all or nothing, that you get all your rates postponed or none of your rates postponed, or can people say, well, I'd like my rates discounted by $2,000 a year because I can afford that, but how do you sort of see it working?
Once again, I mean, in principle, that could be done. It's just what we're concerned about is trying to keep this as simple as possible, rather than giving too many options and complicating the situation. At this stage, what we've worked on the basis that it would be all or nothing, but in principle, it's simply a loan. It doesn't really matter whether it's
That's fine. I guess if they're all in, could they then, like the repayments, can they do optional repayments to keep their growing debt down? That's how they'd manage that.
There is an option to repay, but it's got to be a minimum sum, so people can't be chipping away.
Oh, that's
bits
good.
and
It just
pieces.
gives people that ability to manage how much debt they're taking on.
Yep.
Cool.
Race.
To pass on a bit further, so I'm a simple guy, so this is simply a debt funding scenario. So the house appreciates in value or has greater capital gain, you're relying on that. That property must be sold at the end to pay the debt. So, or come out of come out of the funds that they've got left over or whatever. But that would be through, and so then estates and wills and all that complication. But obviously that's in contracts. Having that tied up. So just making that assumption. So will this be ageist? Will this be open from somebody who has a first home loan? And they can defer their rates from the day that they start working?
No, totally ageist. You've got to be 55 plus, which is based on the arrangements in British Columbia. And the reason for that is what ultimately kills reverse mortgages is the compounding of interest. And so the longer period of time, the bigger the risk of that happening. So we've done quite a lot of analysis around the situation if someone was to take it out at 55, how quickly would the equity in the house be eroded? And so we're pretty confident it'll be okay.
Yeah, okay. I'll see you in a few years. Thank you.
Sophie.
Yeah, mine wasn't so much a question, just to observe we've already got a rates postponement policy. That said, ours doesn't kick in until 65 unless you've got extreme financial hardship or some other sort of thing there. So it'd be interesting to have a look at the difference, compare the two if a paper was coming to us to see the difference.
And it's a really good point. Part of the analysis we did was looking at the different rates postponement policies across New Zealand, and I think all councils have them. It's just the uptake is so low, and I think it's a combination of factors behind that. The population hasn't been aging the way it has sort of recently, but I think there's a cultural issue as well, where New Zealanders don't want to spend all their lives paying off their homes only to remortgage them as they get older. But I think the practicalities of the way rates are increasing and the fact that people are living longer, it's just a reality of things.
Yeah, it's one of those things. Nobody likes it, but actually, if you need it, it's probably that's the time when you want it to be there. But yeah, it's that discretionary income. It's the difference between having a okay sort of retirement and needing to sell the house. Essentially,
it's just providing that choice. So you're sitting in a property, you're on fixed income, you're having to pay bills that are increasing, and you're thinking, well, do I shift? But actually, you don't want to be disconnected from your family and friends, and obviously that has a social connection. Or people potentially have to think about a reverse mortgage, which obviously would be a lot more expensive and would get the equity up much quicker. So this is just an option, and all of those options are available to them. But it just gives people choice. I'm really conscious of time. We have some slides, I guess, on just kind of the mechanics of how the RAS operates, the business case, who's been involved, etc. I mean, they happy to go through those if we've got time, or if you've got specific questions in those areas, happy to answer those.
I wonder, just in the case of time, because we're back on at 1, so I need to give councillors a break between that. But the slides that you do have, can we have those to share around to elected members? I think that would be quite helpful, and actually if there are any questions that come out of that, we could send those on to you.
And maybe just the one slide that might be worth talking about is the business case slide, just to give you a sense for... So the analysis we've focused on is very much like what do you need to believe for the RAS to be financially viable? Because ultimately we're going to need to come back to councils and ask for money to give us the equity to stand the RAS up, and the equity will be needed for paying for the advisors, paying for the IT system up front, so the establishment costs, getting the management or getting the personnel required to operate the RAS. So all that are the upfront costs. But then there's the issue that the RAS on day one won't have any loans, and it'll take time to build up the loan book to cover its costs. So, as I talked about, the RAS will make a net interest margin of 1%. So for every 100 million in loans, it makes $1 million to cover its costs. And we estimate that the annual operating costs will be about 7 million. So to break even, it's got to get to 700 million in loans. And so that's what we've been solving for through all the modelling that we've done. And we look across the three products. You look at rates postponement in British Columbia, they've got over 3 billion in loans now. So you'd have to think over time, if New Zealand was to sort of follow the British Columbia model, it could get almost there on rates postponement alone. It's just likely to take a very long time given the cultural shift that will need to happen in New Zealand. Impact loans, we've got information from ECA and Rewiring that's sort of suggests that there will be quite a strong uptake of those loan products. And then with deferred DCs, which we think could actually be one of the really big drivers of the loan book. Certainly that's the feedback we've had from developers. So we expect, once the RAS is established, that there'll be around $1 billion in DCs across the country. What proportion do we need to actually get of that book each year to help grow the loan book? And our analysis suggests we should be able to get there in 4 years. And so the equity we needs to cover establishment costs and the operating losses until we reach break even.
And just to reiterate, obviously at this point in time, we are just looking for in-principle support. We're not looking for you to make a decision around whether you would take an equity share. So I just really want to be clear about that. We just want to be able to go back to the government to go, we've got a significant number of councils that have expressed interest. I think we're probably up to close to 30 now. And we're at politically, the business case was given to DIA in late last year. They provide some initial advice to the minister, and the final advice from DIA is going up in the next couple of weeks. We've been talking to all political parties. We know some have already put it into their manifesto, but there is broad interest right across the political spectrum. We have been pushing the current coalition government to give us confirmation to confirm their equity share and to write legislation. Their legislation calendar, though, is jam-packed with other things on the go, and many of which you're very aware of, and we won't go into those today. But we are expecting broad political support for this. And so we're just at that point where we're trying to get broad support from the sector. So when we get the green light from either this current government or the next government, we're ready to go and obviously then move to set it up.
Thank you. I look forward to the rest of the slides coming through so I can have a bit of a look at those, and we'll have further discussion as a council. But thank you very much for coming in today.
Pleasure.
Really appreciate you bringing this to us for discussion.
Thank you very much for your time. And look, if you when you do look through those slides and you've got other questions, Hugo, I'm more than happy to jump on a Zoom and answering those at any time.
Great. Sounds good. Thank you very much. public briefing for the 17th of June. Just up here, we've got post-deliberation update on the draft annual plan. And there is also some next steps in there as well. So look, really happy to hand over to the team to work our way through this.
Good afternoon, councillors. I'd just like to start with saying thank you very much for councillors who've provided feedback on the draft annual plan. The team are working hard of progressing through those changes. We provided a change log which records all those changes we received and how we're responding to those changes. There were some, I know that councillors made some comments regarding the reference to the 13.3% that was recorded in the last long-term plan for the year 3 and how that is now different, not only for what SDC is proposed, Selwyn District Council was proposing in terms of rates charge increase for the next financial year, but also what Selwyn Water. We are able to provide there's some space in the annual plan to include an additional page of information to help address that, and so we'll be guided on from yourselves in terms of what you would like us to put on that page to reflect and communicate that the difference between what Selwyn Water and what SDC is doing. Some of the other things that have changed since we provided the report is that we've been informed that the Brands Research Levy is now, we are required to charge GST on that, which was not clear in previously. That's a new directive from MB on that. And when we get to the resolutions on the 30th of June, there will be quite a number of resolutions relating to the mechanics of rates and other things. So it's just keeping you informed of that. Just finally, the changes that we're making now and any direction we get from yourselves today will then be reflected in a draft annual plan which you will receive on the 22nd of June for your further review for preferably minor edits, as we'll have a very short time frame from the 24th of June when Council will consider that to turn that round so we can present that to Council for the 30th of June. And happy to take any questions.
Also, I just wonder, we've got the change log here. Are there any things that you need to comment on in the change log?
It's probably 5.5, which I think is on page 11 of Diligence. I've got on page 12, or you 13, 12, 13.
So page 13 in Diligent is that one. I think, so you're asking us what wording you would like to be on that page?
Yes, is there anything? I mean, one option is taking something that we produced at the consultation plan, where in the consultation document we had a page that illustrated the services that were being delivered by Selwyn District Council and the services being delivered by Selwyn Water and what the respective, proposed rates in that consultation were for Selwyn District Council, and we had just commentary for Selwyn Water.
And I'm sorry, I don't have that page right in front of me, but just thinking about that, because it becomes particularly difficult when we talk about the 18% from Selwyn Water, and then actually what is that relevant to us using weighted averages. So it is, I understand it is apples and oranges a little bit, but if we can start to work towards what that weighted average looks like, so what the impact would be for people, I think is the important narrative to have on that page.
One idea we did have was actually a joint media statement where, after the council had adopted the annual plan, showing what the different amounts are for both Selwyn District Council and Selwyn Water, but using some examples of what it might be for some residents, depending on where they lived. But until Selwyn Water have set their water charges, and until council have adopted the rates, it's probably premature to provide that in there.
Okay. Look, happy to go. I know, Aaron, you had a bit of feedback on the Selwyn Water as well.
Yeah, I think if we're going to continue to contrast 13.3 to 4.5, we need to be completely transparent. And just saying, and by the way, that doesn't include water, it doesn't go far enough. We need to actually give those sorts of worked examples. You know, I'm looking at my own situation. I'm thinking with the water, it's roughly 8%. And if we said it was 13.3 in the old plan, we've cut our part of the rates to 4.5. If we add back the water, it's going to be roughly 8% for a lot of people. Something along those lines would be okay. You might do it another way, but you can't just say 13.3 and put 4.5% against it, because it's just wrong. It's misleading. It's trying to make it look like we saved 7% or whatever it was, 8%, when we didn't. And we came in on the back of being open and transparent, and we're doing a really good job on a lot of things, but we're letting ourselves down if we keep touting that line without fully explaining.
I totally understand where you're coming from, Councillor, and I agree. I think there's a way where we can actually be very clear as to what that 13.3% relates to and what we're proposing for Selwyn District Council, and just being that clear about that.
Yeah, the bit that's missing, which is partly outside of our direct control anymore, is the water, but it's the combined number. That's what people want to know. They're doing the maths in their head, and sometimes they'll be right and sometimes they'll be wrong. But there's commentary out in the social media whenever we put 13.3 versus 4.5. Oh, you're just lying to us, you're fiddling with the numbers, you're not being honest, all that sort of stuff. And we're just setting ourselves up to be hit over the head again when we can avoid it.
Yeah, I agree. And I think, you know, especially in this transitional phase, as well, being our first annual plan without water on there, is to be really clear that, you know, we're not delivering that service. It is delivered by Selwyn Water now, but here is what the total impact is. And it potentially, it'll have to have a disclaimer with it, because, like you note, Selwyn Water haven't actually confirmed 100% what those charges. We've got a bit of an indicative idea, but, you know, can we run a disclaimer on that as well? My one question on it is, and Alison, it might be for you, is are there going to be any, putting that in our annual plan, are there going to be any flags from audit on that?
I think we mitigate the risk of that by virtue of the LGP amendment.
Okay.
I think that's how we mitigate that one.
Yeah, look, we understand absolutely where you're coming from, Councillor, and we will include that information in some way. The uncertainty around Selwyn Water, there may be a couple of different ways to deal with that. It may be that we could say, you know, given what's been consulted on by Selwyn Water, you know, this is the range that we're thinking of, or it may be that, yeah, but very happy to include that, because I agree with you. I think it's more helpful to people. The trouble is, because it varies for every individual and what water system they're on, it's not quite as easy as a rate, as you understand only too well. So we'll do something.
Part of it could also be not putting 13.3 right beside 4.5, because if you say the old one was 13.3 and hooray, we've done 4.5, the implication is that we've made this amazing saving, which we have made some savings, but not that extent. So you could say the original plan was, when it was combined, was 13.3, and that all included the water charges. Then talk about the water, and then say, and now we've got a situation where the council is 4.5, Selwyn Water indicating around 18, blah. So separate those numbers so they're not right beside each other, and we're trying to show that we made that change from there to there in one fell swoop.
Yep, understood, and we will do that if that's the will of council.
Sam?
Just one thing I'd like to mention is that if you're not on sewer and water, it's 4.5.
Correct.
or hopefully lower.
Sarah?
This might be completely random, but are we required to refer to the LTP Year 3 13.3 and make that comparison? Or can we just look forward to the 4.5 and whatever the Selwyn Water figure is?
Generally, we would always have a comparison in there. And I think it's more a question, it's similar to Aaron's point as well, is we're not comparing apples with apples.
No.
We've got apples with grapefruits or oranges, whichever fruit choice you want to go with. And it's whether or not we can show that shift between the 13.3, the long-term plan amendment, what's came out, what's gone in, so that tells the story. And I think that's something we'll just need to go away and have a look at. But generally speaking, in any report, you are required to show the prior period adjustment or what we were working on previously.
It
It's
just
just good
seems
practice, yeah.
that it muddies the water so much in
Understand.
this case.
Yeah.
Yeah, it's a really difficult one to make clear to our ratepayers, and you just wonder if we can simplify it completely, if there is a way to do that, that makes sure that we're ticking the boxes for audit. It might be useful.
Yeah, and I think, Sarah, what I might do just for completeness is take it up with Audit New Zealand, just to make sure whatever we do now, we're future-proofing ourselves, so we're not going to come up against the audit problem. I personally don't think we will by virtue of the LTP amendment, but we'll just make sure we've got everything in order.
Cool. I guess, councillors, the question is there anything missing from the change log from feedback? I just note that I'm still working on the welcome page there, and I will get that tidied up and sent on to Rob. And I think just one thing, I note that before we put the annual plan out, we'd missed a couple of things from the proofing. Are we confident that we've captured all of those in this document too?
I think we have, but if there's anything any councillors have identified that we have missed, it is a small team that are reviewing it numerous times, so it's your fresh eyes are really valuable, would be great.
Don't know about the others, but I found it a really useful way to be able to review it, to be able to see what the other councillors were feeding in to avoid duplication or to be able to re-emphasise a point was fantastic. So thank you for that clarity.
Okay. I just note within the update as well, we've got capital project carry forwards, and so I wonder if there are any questions from councillors on what we've got there, just for clarity so that we can move forward and the team can actually start to prepare this annual plan in full, because when we get to the 24th of June, we will effectively be looking at, you know, if there is a full stop missing type situation, so no big changes to the document. So I've got Aaron.
There's a couple of mentions of Springston Reserve, and I've looked on the maps, and I don't know if the map I'm looking at is the one that was for the election boundaries, but from what I can see of that, Springston Reserve is within Springs Ward. So I don't know if there's different maps.
Sorry, Aaron, can you just repeat that because I was walking from A to B?
There's a couple of mentions of Springston Reserve in here, and they're classified as an Ellesmere. But if I look on the ward maps that were published at the election time, which I take as the most current ones, to my eye, the reserve looks like it's in Springs. There is a boundary that's with Ellesmere, but I think the actual reserve sits in Springs.
Yeah, we have picked up a couple of ward challenges, and there's a table that details all the projects ward by ward that's not included in this particular update, but it will come on by the 25th. So there's a couple of them that have changed wards and a couple of them are being reclassified as district-wide. So we have caught that, thank you.
So those will be tidied up with the latest version that will be provided.
That's great.
For councillors. Cool. Okay. Sam.
Thank you. Just clarity on why we've got so much variance in annual plan consultation versus updated budget. West Mountain tennis courts, 1.2 million, nearly 1.3. Lincoln Library costs more than doubled. Footpath has doubled. Even vehicle purchases costs have gone up exponentially since we consulted not that long ago, and I think we owe it to our ratepayers to sort of why.
Sure. Just a little bit of history here. So the numbers that we presented at the consulting phase were taken from our position as at the end of November 2025. So we were at that point roughly halfway through the spend of the annual budget. What you see here is, best way of describing it is a rephasing of budget. It's not an increasing costs. So in some areas, we've managed to complete more than expected, but in quite a number of areas, and that's the top of the table, we're behind delivery. And so what you're seeing here is money that we weren't able to spend in financial year 25-26 now being moved forward as a carry forward into 26-27. So it's not an increasing cost, but to balance the budget and stay within that envelope of 86 million for the total capital plan of the year, the bottom of your table also shows a number of numbers in brackets, which are things that we know because of the current progress on those, we can additionally push out to 27-28. As part of that rebalancing of the program. So there's not an increase in cost, it's about the phasing of the delivery and a difference in where we anticipated we would be in November of last year and the reality of where we are today when we review it. Things like the vehicles, that's an easy one to pick up. We've ordered a number of vehicles as replacement for aged vehicles, but the vehicles we wish to purchase, which are highly efficient vehicles, are in great demand, and the allocation of those vehicles is all spent up, and so there's a back order on those vehicles. So we've placed the order, but we can't pay for them until they arrive in the country.
But if you're buying the same vehicle, why does it cost you $200,000 more since November?
It's a carry forward budget.
No, we didn't spend it this year, so we're carrying the balance of that forward into next year and adding it to next year's budget. So no, it is another one of those rephasing, and just to take you back to the conversations we had when we're going through the prioritisation, the rephasing of this is predominantly on debt funded items because that, we can't move the targeted rates or the DC funding around in the same way. So all we've looked at is to identify where can we make these movements, or where are these movements happening to balance out the budget. So we've gone from a carry forward position anticipated in November of last year of $19.5 million to an actual, here we are in June 2026, of just over $26 million. So what we haven't spent is about $6.5–7 million worth of money that we anticipated spending last year in the capital area, mostly debt funded, that we will now move into the next year. Does that make sense?
Mm-hmm.
Okay.
Thank you.
I'm happy to explain any of them on an item-by-item basis, but it's quite a comprehensive piece of work that's gone in. The main thing is that the capital expenditure for next year is still the same quantum, but there is a rephasing element, and that rephasing is focused on maintaining levels of service.
Thank you. And Sophie.
Yeah. Kia ora team. We're getting closer to the end of this journey, she says, hopefully. First thing I had was just to support Aaron's one. There are 2 projects on this list, which it's not that they should be district-wide. They literally are listed as being in the wrong ward. But that's an easy fix. I had 2 questions, though. One was around State Highway 1 Duns Crossing Road cycle underpass pathways. And it's got a 0 for the update, saying awaiting final claim from NZTA. So what happens if that final claim arrives during next financial year, or if they already claimed it? Sorry.
No. So this is one where there's a little sensitivity around this. So originally we set out with a cost share agreement between ourselves and NZTA. NZTA have verbally confirmed, but not in writing, that they intend to undertake the project works entirely themselves. but we carry a contingency in case we revert back to the original intent that there was a cost share agreement. So what you see there is simply us carrying an accounting a provision in case it materialises. If it doesn't materialise, then
Wonderful.
it's a good news story.
That would be lovely if it didn't materialise. And the other question I had was on the mention of the White Cliffs Bridge replacement, because obviously we discussed that last week, and there's a different number now than there is on this sheet of paper.
Yes, so there's two things about the White Cliffs bridge replacement. The number that's shown on this particular piece of paper is not the whole story. There is a considerable sum of money that would also sit in the 27-28 area.
Right.
So at this moment in time, we're still waiting for the response from NZTA on their share of funding. In the event that they come back with the positive response that we are hoping for since the presentation on White Cliffs Bridge last week, then that money will be firmed up in the 27-28 budget, which is why you see a relatively modest change in this plan, even though the overall scope has happened. If NZTA don't come through with that money, then the whole project comes back to council for decision.
Yeah, cool. Thank you very much.
Tracy.
Mine are just two comments about Kuwi. You've got two items there for Kuwi. Kuwi is in Melbourne. It is not in Springs. Thank you. That was it.
Cool. Bruce.
Well, great on the topography and geography for the region. Just going to the last page on with the targeted rate grants in the DCs. Can you please give me further on the grants and subsidies and DCs of the reduction there, when I would have thought forecasting was fairly clear for what DCs would be coming in, and now it's less? You're going from 12 to 10.
That's Alison. Could we stick with the capital stuff first? Thank you. Just then we can get rid of Keith.
I can try, yeah.
Wow. You can prep.
Is that a bit harsh? Sorry about that.
I'm used to it.
We do love him.
Okay, Sarah.
Just a very small, quick one. What is the building renewal for Springs? That's referred to, fourth line from the bottom there. Generic title.
It is a very generic title. I will have to come back to you on that one if I may.
Okay.
Yeah. Sorry, from the purpose of explanations, what I asked from the team and were put together, it's basically everything above $50,000. So I'll go through and chat that one. Thank you. Come back to you.
Okay, so that just leads me to, in the paper, it says for the 6 projects above 50k that currently do not have rationale, these will be provided on the 17th of June. Are they within, they're all in here?
They should all be in here.
Okay. Okay. I wonder whether we go to Alison for the question on funding.
That was quick, Alison, wasn't it?
That's beautiful.
So can you please just explain the reduction in the DCs for the budget for a starter?
I think to give you a fulsome answer, if you don't mind, I will come back to you and have a chat with Peter. I think as we noted in finance performance, the DCs are actually a bit higher than what we'd expected now. So I think it's the timing between where we are, current state, projecting out to future state. But for completeness, let me come back to you, Rhys. And I can do that in the next 24 hours.
That would be great. Can you do the same on grants and subsidies?
Absolutely.
Okay. And the Lincoln Town storm, whoops, might need you back, Keith. Is that the difference that was within stage 1 when the stormwater was added to with the, or is this to be spent, or is this LTC stormwater? There was a variance, there's an $800,000 variance or extra. I am looking at, I'm actually looking at page 16 on Diligent. And it's described as LTC stormwater. It's the top. It doesn't have a number. It's in the table of the finance. Oh, sorry. It has a variance of 842,000. 16 on this one, but it depends on which update. Yeah.
So it was roughly $1 million. Yep. So where we've got to with a stormwater side within the Lincoln Town Centre, we're trying to.
Keith, do you want to just chuck your mic on, please? Thank you.
So with the stormwater program at the Lincoln Town Centre, we're trying to coordinate all of those works so that we do them once and do them at the same time. So that will be money that will be added into that program to complete the works in line with all the phasing of the project. So that will be an increase in the debt.
So it wasn't the stage one stormwater funding that's actually been spent. This is forecasted, right?
I will check that, make sure that we're
because it would be a good story if it was, because it was briefed as
I will
being
confirm
greater.
that.
Thank you.
Cool. Are there any other comments on the capital program? No, I think, and so, you know, this is the list that came from our finance performance meeting, which I want to say last week, but was it the week before? I feel like the time is all merging into one. And we talked about what the carryover funding was going to be. And so that is what is detailed here. And so it is good to see that detail of actually what is being carried over into the projects. And I think I had an earlier question is, does this have an impact on our financially on our rates and on our percentage? And the question, the answer to that was no. And so that is a nice feeling. Team, is there anything else that you, on the annual plan, on the draft document, on the change log, on the capital program, that you want to add in any feedback on this, because the team need to start to put this together into a clean document now? Sam?
Can it be any lower?
I think the short answer is it's your plan. You tell us.
Make it lower.
Do you want to take stuff out?
I think what's in front of you just now is what we've agreed through the deliberations and the changes. So to make any further changes, then we run the risk of having to go back out to consultation. So this is the numbers that we have sort of all agreed in this room that you as a group have agreed to. I personally don't think we can push this any lower without changing any of our levels of service or running the risk of having to come back out to consultation.
Okay, thought I'd ask.
Cool, thanks, Sam. Okay, best wishes pulling all that together. I look forward to seeing the clean copy of that, and I'll give it a really thorough read through and proof on that before that. And I promise that I will get my welcome to you.
And look, thank you very much for all the work that the councillors have done. You've obviously all done your homework. We've had good feedback. That's really allowed us to keep moving this thing along. So the timelines are very, very tight. So we've really appreciated that focus. Thank you very much. It makes it a lot easier for us.
Cool. So yeah, next steps on that, like we've said, the 22nd you'll get effectively a clean copy, and just make sure that everything is, there are full stops everywhere where there should be. And this is where proofreading skills come out to play, and then we'll be in here on the 24th of June and just making sure that that is all good. And then the 30th, which is looking to adopt the annual plan and strike the rates. And so, as the team had mentioned, the resolutions that'll sit in the paper for the 30th are very procedural and prescriptive and quite mechanical in nature. But anyway, that'll be part of that paper. So that takes us to the end of our public meeting today. So thank you very much.